My specialization is in fixed income, and I teach finance. That is my background, and so we have a variety of students from different courses. But then again, at the end of the day, it's investments and portfolio management. Let's ask the question. Let's be honest. Why are you all here? One important reason. Heart to heart. You want to do well in this unit, right? Why am I here? I have my teaching responsibility. As an academic, I have 20 or 30% teaching and research and administrative duties. As a university has certain responsibilities. It is accountable to the regulatory bodies because they give the license. So they require the university to maintain certain standards. And apart from, the noble ideas of gaining knowledge and all, there are some contractual agreements. You want to do well in this unit because at the end you want to be employed by your desired entity and you want to complete the course. That is the reality, right? And I am here to ensure that you meet those learning standards. The university requires certain graduate learning outcomes, and I set certain unit learning outcomes to achieve those graduate learning outcomes. So we know that very clearly. We have outlined in the unit guide. So long as we meet those objectives, we are fine. In the process, always we are bound to have some pain, pleasure, and all of those things. These are not things that we dictate, but these are things that we need to go through to satisfy certain criteria. At the end of the course, I want you to have some takeaway in the form of skills and some tools and techniques that you can employ in your own investment management or portfolio management. So that is the purpose. As you know, there are 3 pieces of assessment. One is the reflection report that you need to write. I have uploaded this assessment. I uploaded this last night. Assessment 1. It accounts for 10 marks. All you need to do is, you have no knowledge of trading, you have no knowledge of portfolio management. I don't expect you to have any knowledge of stock selection, but you start trading. In order to do that, you need to complete the registration. There are some protocols that we need to go through. There are some important deadlines. The deadline for this assessment, the reflection report that you write and submit, is on the 4th of August. That is the final report against which you will be judged. In order to write the report, we need to go through a process. The process starts today itself. The deadline for registration on Stock Track is 14 July. I think I have given this link on my lecture slides. And I also left a message on Cloud Deacon last night, so the link is there. All you need to do is just go and click on that link and put that class name and your details. I have outlined what you need to do. You need to make sure, come in, that you follow those steps. The student ID, your username, because Stock Track is a platform that we engage that is outside the university. So in order to track your performance and track your trading, we need to identify you. So the only way we can identify is by your Deacon username and the student ID number. So make sure that you register on or before this Sunday, I think. 14 July means it is this Sunday, right? So there is a critical deadline for you. So this will allow you to start trading from the 15th. You will go and buy and sell shares, explore different shares, and you can select whichever sector that you want to buy, and you may decide to hold on to that particular stock for a while, or you may do some day trading. There is no limitation on those things, but other than those protocols. You can't do 25% above, 25% or certain criteria that you need to meet in terms of trading. That all comes with the platform, and that will guide you. All you need to do is you need to explore this thing by doing those trading activities for 2 weeks, from 15 July to 27 July. And try and engage every day and complete that trading so that you learn in the process. At the time of initiating these trades, you will not have any idea, or I assume that you won't have any idea. You can go on to buy whichever stock that you feel that that is good for you and good for your portfolio, and there is no competition. Although you can always try and maintain performance in terms of return and risk. But that is not necessary. At the end of the day, the reflection report is all about your experience. And by the time you write this reflection report, you will have completed about 3 topics. Topic 1, 2, and 3. Topic 3 is the essence of this unit, asset pricing and portfolio management. That takes a while to understand and digest the ideas. And I'll be teaching up until topic 3, and also and Dr. Bernard Ike will come and teach 4, 5, and 6, I think 7 as well. Maybe I will come back to topic 8, international investments, and the revision lecture. But I will control the whole thing as the unit chair, and I'll be available online. In terms of that, that's the settings. So please make sure that you complete the registration on time so that you have enough time to trade. I have seen in the past students missing the deadline and then trading only for a week. That's not a good thing. In order to write a clear reflection report, you need to make mistakes. You need to reflect on those things. And then you need to write how you could have done things differently had you known all of these steps, A, B, and C. Obviously, in topic 2, we will look at the systematic way of stock selection. That is, you go by the country's macroeconomy, and then you penetrate into the industry sectors, and then you go and analyze individual companies for stock selection. Of course, you don't have the luxury to do that. You may just decide, okay, looking at the newspaper, BHP could be a good buy, or it should be a sell. I think the platform allows you to do some short selling. That means selling those stocks that you don't have any ownership for. Okay? So that is about this. So this is an important thing. Can you hear me at the back? Yeah? Yep, good. So this is an important piece of assessment, and it has a critical deadline. So make sure that you do that. Any question on this? Yep?
Are we allowed to just trade stocks with ASX? Or
This is limited to ASX. ASX is good enough. The Australian Stock Exchange is one of the highly developed markets. Although it accounts for only 1.5 or 2% of the entire global equity market, but microstructure wise it's a sound market, so use that market to learn. Yeah? Any other question? So please make sure that you have a deadline on this Sunday to register and then start trading. You don't have any other deadline until the 4th of August. Okay? So that's about it. This report is due on 4th of August, exactly. No report is due prior to that, but in order to meet that deadline, you have this first deadline of registering and then doing the trade. And also when you do the trading, make sure that you take notes. It is easy to ignore those the note-taking habit, but then when it comes to writing that reflection report, you need to know what you did during that period. You may think that you can remember all these things, but it's not like taking notes and reflecting on it. So make it as a habit to take those notes as you trade, as you move along that trading window. Okay? Anything else? Thank you. So that is the assessment, and it is on Cloud Deakin. If you go to Cloud Deakin, again, let me just, some of you may be new to Cloud Deakin. There are some exchange students as well. Different countries have different platforms, and some of you may be very familiar with those things. So under the resources folder, I have the unit guide and the learning. There were some errors in the unit guide, in terms of deadline. That was That was an error that was introduced by the central division. What happened was when we were about to upload the unit guide, something went wrong, and then they had to do it. So all these dates had some issues, but then I rectified all these at the beginning. So you don't need to worry about that. So here we upload the lecture notes, and also we upload a document that outlines the readings and gives some information about the topic and the topic questions. We draw all the topic questions from the textbook. So this is your textbook. Okay, this is 2019 edition, Investment Analysis and Portfolio Management. Try and buy this. I have also sent a message to Cloud Deakin on the coupon that is available. They have 10% or 20% off for the online copy. I think the online copy would be nice enough. If you don't want to buy this hard copy, we'll be drawing questions from this textbook, and we'll be closely following this textbook. So it is advisable. Think about it. It may be $70 or $80 compared to the money you spend. That is nothing. But the learning will be more effective when you spend that money. I'm not campaigning here for the publisher or anything, but my interest is that you need to maximize your learning outcome. Okay? So you can buy this online version, that online copy. I know these are expensive. They also may have these overheads, these publishers. So that is the reality at the end of the day, and so please make sure that you buy this textbook. I also have my on-campus, off-campus students, so I need to show them as well. So so this is the textbook, and as you know, this is the 2019 edition. So essentially it is 2012, but 2019 print. Okay, that's about the textbook. Now let's get to this document. I'm sure you all okay, so it is the topic guide. Under the resources folder, you have this financial markets. This is the PDF document. I'm not sure why this is not. Were you able to download this? Huh? Yes? Yes. Thank you. Okay. So this is the first topic, and we have some chapter readings coming. So there are 3 chapters, as you know, in this topic 1. We don't expect you to read everything, but you are welcome to read. But at least cover these essential readings. Say chapter 1, pages 3 to 20, read that. And chapter 2, again, pages 33 to 44, and so on, and chapter 3. So complete those readings. And we drew all these questions, all these questions from the textbook. So you can see question 1.1, 1.2 and 1.3. These are the overarching questions from individual chapters. And there are other a subset of questions or problems. So as part of this exercise, now I will cover about 2 hours of teaching, covering these conceptual issues. And then I will cover 1 hour of tutorials or 1 hour of questions. Okay, so that's how we have organized it. It can be at the beginning or at the end. Generally, we will cover the first 2 hours for the conceptual knowledge, and then the balance 1 hour for the tutorial questions. I know I have identified these individual questions, but I will not be able to go through each and every question in the class, but I will selectively do that. But you are supposed to attempt all of the questions. So when you come to the class, make sure that you attempt them on your own, and then come to the class. Then come to the class, please. Okay, so that is about the topic guide, and then we have all the individual questions. We have taken extracted those questions and given you that, and also the suggested solution is there. You don't need to look at the suggested solution. First, try and do it. Face the situation, and then go and consult the solution at the end. Okay, so this is the document. So this is one of the key documents that you need to use as a guide. And then we have these lecture notes and other supplementary resources. And also one more thing, and I don't use PowerPoint. I write my own lectures using the LaTeX program. So I don't have the luxury of not moving away from the PowerPoint, the PDF documents. So my lecture slides are in PDF form. I have no control over it. The program produces those in PDF forms. So in order to minimize your cost or printing cost, I have uploaded 2 to a page and 3 or 4 to a page, as well as the slides. So there will be 3 versions. If at all you want to minimize that cost. Okay. All right. So that is about the Cloud Deakin platform. And any questions so far? Okay. In terms of my contact details, I'm in building LB, Elgar Road, on level 4. My office is 4.309. I'm there most of the time. And I will put my consultation hours, and you are welcome to see me anytime. If you have an issue or if you have an issue, then put it on Cloud Deacon and we can address that. Everybody will read it. So that's another way to deal with issues. But if you have any anything that you don't want to put it on Cloud Deacon, you can come and see me. And also, if you have any issues with respect to any conceptual issues or anything, or you want some more some clarification, come and see me. I'm there to help you. You can also reach me on that email, or my contact number is that. So that is that's about the details about me. Now, in terms of this unit, there are 8 topics, as you know. The first topic is financial markets. We will look at the overall understanding of what we mean by a market, and then investments. So we will essentially set the scene for this unit in topic 1. Then topic 2 looks at stock selection. Stock selection is about how systematically we approach this process of stock selection by looking at the macro level. Then we move to the industry level, and then at the stock level, at the individual stock levels. That is the systematic approach. That's the top-down approach. You start with the regions or individual countries, then you look at the industry level performance, then you move on to individual stocks and analyze, work out whether it's a good stock to buy, or it's a sell, or whatever decision that you need to make. This goes with all other investment products as well. Fixed income, again bond valuation, and also derivative products. Okay, so the country level analysis, the industry analysis, then at the individual asset analysis or company analysis. Then portfolio theory. The topic 3 will focus on portfolio theory and asset pricing. Here we will look at the modern portfolio theory and how we optimize our investment process to achieve the best outcome. And also in the process, we will also learn about the asset pricing theories, including capital asset pricing model, arbitrage pricing theory, and other forms of asset pricing models. Under topic 4, we will learn about how this investment process can be transferred onto a specialist manager. Well, if we don't have a knowledge of managing our investments, then it is better to hand this over to a specialist manager, right? You may have a finance degree, a finance specialization in your master's, or a PhD in finance. It doesn't mean that you can go and buy those stocks or make decisions on those critical asset classes, right? Beyond everything, there is also some aspect of things that we may not be in tune with. That is the intelligence side, what's going on with respect to a stock. But these specialist managers are on the ball all the time. They know the market conditions, or at least we think that they know, and they make decisions. So this is one of the reasons why people tend to hand over the management of this investment activity to specialist managers. They have access to a set of information that we may not have access to. So at the end, you may become a specialist manager. When you join a firm as a specialist manager, you will have access to a number of resources, right? That is one of the reasons why we allow these funds managers or managed funds to handle our investments or invest in those managed funds so that we get a better spread or diversification, and also we get a better insight into what we are doing, right? So that we will cover for 2 weeks. And then we will focus on then for the next 3 topics. The next 3 topics, 5, 6, and 7, focus on individual asset classes, starting with equity as an asset class and its derivatives as a risk management component, and then fixed income, bonds, and finally the property as an asset class, right? So these 3 asset classes will be the focus of topics 5, 6, and 7. So you can see we start with the overall understanding of the financial market. We go on to do a systematic stock selection in topic 2. Then we learn about the theories behind portfolio management and investment management and asset pricing. Then we look at whether we need to do it on our own, or do we need to hand this over to a specialist manager, or do we invest in those funds that specialize in those asset classes. So that we learn in topic 4. Then from 5, 6, and 7, we focus narrowly on individual asset classes to get a better understanding, better feel of these asset classes to be used as part of our portfolios. Then finally, we make a case for internationalizing our investments. The question is, do we confine ourselves to the local market? And by doing so, what are we doing any good, or are we damaging our portfolio? You will see that more and more evidence of return enhancement and risk reduction is achieved by internationalizing your portfolio. So we will look at that the case for internationalizing your portfolio rather than localizing your portfolio in topic 8. Then finally the revision. The revision class, of course, today is Friday, and I didn't have any control over how the timing of this lecture and the day of the lecture, because these are large aspects handled by university bureaucracies. And Friday also, the last Friday of this trimester, is also that AFL holiday. So I need to organize my revision lecture on another day, and I will provide information about that in the next couple of weeks. So as I told you, the university expects certain graduate learning outcomes. As a graduate of this university, what type of learning outcomes or what type of attributes you will have. That is the vision of the university. And we cover 5 of those attributes out of 8 in this, at least in this unit. And you will have, first one is you will have some discipline specific knowledge that is finance based, and also about portfolio theory and investment management. That is the discipline based knowledge that you will obtain by doing this unit. And also you will have some digital literacy, that attribute you will have, critical thinking, because part and parcel of this assessment process and all of the things that surround these units require critical thinking and self-management, because all of these assessment works and your studies are individuals, and you need to manage your timing. So the key to doing well is doing it early enough. If you start writing the reflection report just on the last day, it's going to be a draft anyway. It's not going to be a fully fledged, well thought out report. But should you start this early draft on the 28th, or produce that early draft on the 28th or 27th or 29th even, then you will have enough days to reflect. The learning does not take place until you reflect on it. It is the reflective learning that brings about results. Just looking at, yes, I understand that, I understand this, that's not learning. By looking at your computational things, I can understand this, that's not learning. Learning is about having that reflective thoughts. So by producing that piece of assessment on the last day, you are not going to have any reflective component on that piece of work. Whereas if you produce that on the 29th or 30th, you'll have adequate time to reflect on it, think about it. Oh, I could have done this, I could have done that, let me change this, let me change that. That is when, this is the difference between those who produce a remarkable report and a mediocre report. A remarkable report comes through the reflective process, completing that early enough, putting that dirty draft first, and then reflecting on it. One by one you will fix. So make it as a habit, please. That's what produces that HDs and high performance, nothing more, nothing less. Being organized and doing those things, okay? Self-management is very important. You need to build your character. And also the global citizenship, that is one aspect that the university is struggling with, how we can build graduates to be global citizens. And we are incorporating slowly in each and every unit. And that is one aspect that we cover in this as well. So then, having looked at the graduate learning outcomes, which the university wants you to have, now we achieve that through those unit learning outcomes by looking at the specific areas of financial markets, knowledge on managed funds, and also ability to analyze and relate key principles to portfolio theory and asset pricing, an understanding of different asset classes, equity, fixed income, and property. And then about managing risk and the need for internationalizing your investments. So these are the ULOs, or unit learning objectives, through which we achieve those graduate learning outcomes. So these are the learning outcomes you need to be aware of. I know it is boring, but at the end of the day, you need to be aware of it, what we expect you to do, and by closely aligning your objectives with those things, you will do well. As I said, there are 3 pieces of assessment. Assessment 1 is for 10 marks. Assessment 2 is worth 30 marks. Again, it will be an optimization process. I'm trying to, I will integrate Bloomberg more and more into the teaching process so that you are in tune with the cutting edge practices in the business world. So essentially I will have some exchange traded funds to do that optimization process, the details of which I will release in the next couple of weeks. Then we have the final exam accounting for 60 marks. And we also have a hurdle rate of 50%. So you may have, let's say, 35 marks in your progressive assessments, but then you also need to score enough, at least 30 marks in the final exam. It's not a big deal. It is doable so long as you do your part. There is a very low failure rate in this unit, but that doesn't mean it's an easy task. You will go through this and you will understand. Sometimes you may feel that nothing is moving. When you take 1 step forward, 2 steps backwards. But that is the reality. But if you understand the pain associated with that, then you will know that why this happens and what do I need to do. And once you associate a meaning to the pain, it no longer becomes pain. That's what Viktor Frankl said. Yeah. Yeah. Yes. The calculator, generally we allow all of the calculators, so long as it is not a programmable calculator. But I use this calculator. I'll just put the camera here. So if you are going to buy a calculator, if you already have a calculator, that is fine. Yeah, this is the calculator I use here. You may have some other calculator. That's fine. You don't need to go and buy it. So long as it is scientific enough to do those log transformation and those things, that should be fine.
So
yeah. Yes.
in topic 1, there's some formulas, there's a couple of pages of formulas. Are we required to memorize those?
Right, there will be a formula sheet. There will be a formula sheet in the exam, but we don't need to memorize it. All we need to do is understand what's going on. That's all we need. And once you understand that, you will make sense of that formula. So that becomes subservient to everything else. So understanding the process and why that formula is presented that way is all that we need to understand. Other than that, these are just some squiggles that we write. But if we understand the process, it's not a difficult thing. and it is not, you don't need to memorize it. All you need to know is the process, okay? So it is a doable thing, and you may see some double sigmas and all those things as we move further down. Please understand, if you make sense of the process, why we do what we do and what's going on with those loops, then nothing, it is nothing, that's all, okay? So you'll be given a formula sheet, thank you. And all you need to do is you need to understand the process. Yeah.
So can the financial calculator, the HPV11, is insufficient in the scientific?
And no, the financial calculator is fine. I think it is scientific enough, I think. It has all the functions. But if you are familiar...
Cos and tan and cosine.
No, you don't need to go there. It's only the L and the natural log. I think it will have natural log. So the natural log, I think the natural log is here. This is the natural log function that we'll be using. Let me blow it up a bit. Yeah? So this ln is the only function that that we will be predominantly using it. So long as you have that, most of these basic scientific calculators will have it. I'm sure the financial calculator will have it. Yep. Okay. Any calculator is fine, but at the same time I want to also remind you one thing. These exams, supervisors are, sometimes they assume more power than what they are supposed to do, and go on to dictate things, and they get agitated with certain calculators like programmable calculators, where you can store information. So long as you don't go towards those programmable calculators, you are fine. Nobody can deny any standard calculators in the exam. I feel this is a financial calculator, or this calculator, or whatever calculator you have should be fine, so long as it is not programmable. But if you have a programmable calculator, make sure that you get rid of all the text. The user input should be deleted before you enter the exam. Okay? Any other question? Right. So, so final exam is worth 60 marks. So long as you do a decent job, it's not a problem. Everybody can earn, good grades. So make sure that you do your part. All right. So that is about right. And again, assessment 1 I have already covered. This is the link. And I have also provided the link on Cloud Deacon. Click on that, please, and just go and register. Register, follow these steps, and then you should be fine. As I said, the seminar is 3 hours, and we'll have break halfway through, or whenever you feel like, we can have a break. Yep.
Registration is not working yet.
Really?
Yeah.
Okay, I'll attend to this. Okay. Okay, I'll write to them, and I'm not sure why. Okay. So what is it doing? Did you?
It says registration for the seminar has not yet started.
Oh, really?
Yes. The dates
Yeah. Yeah, it should be ready. Leave it with me. I'll attend to that. Okay. I'm sorry about that. I didn't know that. Okay. Let's work out something. All right. Thank you for letting me know. Yeah. So as I said, roughly 2 hours seminar and 1 hour of tutorials, and you are supposed to do all the tutorial questions. Please attempt those things, and I'll cover whatever I can in the class, and then if you have any issues, then we can discuss and deal with those issues. Now, so today's topic is about financial markets. But before we understand financial markets, let's understand what we mean by a market. What is a market? Market is a place where buyers and sellers come together, right? You have some items to buy, you need to buy, and there are sellers who are willing to sell. So it doesn't need to have a physical location like a marketplace where vegetable markets where we go together and buy and sell things. It doesn't need to have a physical market, right? Think about eBay. Think about Gumtree. There is no physical market in existence. And oftentimes these markets don't own those goods and services, right? And for example, Aldi. When I was doing my sabbatical in Germany, I was talking to my colleague. Aldi is a setting where I may be wrong here. Whatever happens here, at least in Germany, what happens is Aldi provides this place for different manufacturers to bring their goods and sell at a rate dictated by Aldi, and it's a market, it's a platform. If they sell it. If they don't sell, they need to take it back. This is my understanding based on my casual discussion with my German colleague. So this is again a marketplace. Aldi doesn't own anything. They tell the manufacturer of milk products, okay, you can supply some brands here, bring them, sell them at this price, maintain the quality. If you sell them, you sell them. If you don't, take it back. So similarly, markets don't have to own anything, right? eBay doesn't own anything. You are a buyer, I'm a seller. We just come to an agreement online through a bid process or whatever, and we exchange goods and services. So you don't need to have a physical location, and the market does not need to own goods and services. And also the market can deal with variety of goods and services. If I'm an electrician, I can go and put my service as I'm available for electrical work, plumbing work. Or if I have some items to sell, I can sell those items on Gumtree or whatever platform, right? So variety of services. And also, by having this marketplace, both buyers and sellers benefit from that. Buyers benefit from buying that product, and sellers benefit from selling that product, right? So, so that is the feature of a market. Before we get into the feature of financial markets, again, the characteristics of a financial market is that it has all the microstructures. But we will not study the microstructure in this unit. That's not the thing that we cover here, but it's the understanding of how financial markets are organized is what you need to understand in this unit. We will limit our examination to that point. So what is the characteristics of a good market? A good market has timely and accurate information. Sorry, I have this weak lungs, I think. I don't know. So I have this cough as I speak, and I develop this cough. So intermittently, bear with me, please. So a characteristic of a good market is that it provides timely and accurate information. As you enter the market, you need to know what the past transactions were and the volume of transaction and the price at which these goods were transacted. All that information you need to know. And not only that, you also need to know what those outstanding buy-sell orders are, bids and offers. You need to know all that information to make a decision in the market. So in order to make that decision, you need to be armed with this type of timely and accurate information. As the transaction occurs, you need to know what those prices are and what those quantities are traded. Quantities traded at that time. And also you need to know the depth of the market by looking at the bids and asks presented there. There are buyers all the time there to buy at certain prices, and sellers have put their prices as well at which they are willing to sell. So a characteristic of a good market is that it provides that timely and accurate information. If you don't get that timely and accurate information, then what will happen is you will not be able to judge whether the price that you are selling at is the right price. But if you know the past prices are that, and I'm not deviating too much from that past price, and also the outstanding bids and offers are such and such, then I know what to do, at what price I need to buy or sell. So the participants, market participants, will be able to engage in the market activities in a very informed manner. So because you have this timely and accurate information. And the second quality, I mean, this is important thing, you know, the characteristics of a good market. It may be even examined. The characteristics of a good market is that it provides timely and accurate information about the depth of the market. Past prices, outstanding bids and offers. And the second feature is that the liquidity. Liquidity is what? Liquidity is the ability to sell as and when you want to sell it. That means there are enough buyers and enough sellers there to transact on those goods and services. So if you have a situation where you cannot sell it when you want to sell it, or you cannot buy it when you want to buy it, then that's not a good feature of a market. What it means is that there are not enough products available on the market or services available on the market. There are not enough buyers and sellers, not much trust existing in those markets. So those are the reasons why that liquidity is lacking. So liquidity is an important feature of a good market. As and when you want to sell it, you should be able to sell it and get out of that market, right? So again, there are two components associated with liquidity. Market liquidity is, one is the marketability. Marketability is that you are able to sell it quickly. You enter the market, put the sell order or buy order and execute the transaction. Marketability. That is only one aspect of liquidity, and the other aspect is price continuity. Price continuity is that you are not going to deviate too much from the prior price. Say for example, you are buying BHP at let's say $40. The last price was 40. In order to ensure the price continuity, the next price at which you are buying or selling shouldn't be 45. It can be $40.20, because you should not too much deviate from the price. There should be continuity unless there is an information, new information about that company. It may be that they have found some gold. Then it may hit to 45. There is a reason for that. Other than that, price continuity should be maintained. A market that is a good market that possesses that characteristics will ensure that price continuity is there. You are not going to deviate too much from the prior prices, right? So that is the liquidity is the second aspect of it. And there are two components. One is the marketability, sell and buy as and when you need to quickly without losing time, and also price continuity. Price continuity is that you are not deviating too much from the prior prices. And also the third feature is that it should offer low transaction cost. If the transaction cost is what? It is kind of commission. Say you contact your stockbroker and ask the stockbroker to buy 1,000 CRA shares. And if you are going to pay a transaction cost of 40% to execute that transaction, it is quite high, whereas it should be 1% or 1.5%. Say for example, in the housing market, real estate agents charge about 1.5 to 1.7%. If they are going to charge 20% of the sale price, no one is going to sell, no one is going to be very happy to sell and pay 20% of that selling price to the broker, to the agent. So the transaction cost should be low enough to maintain that internal efficiency. If you have high transaction cost, then what will happen is you will not be able to maintain that internal efficiency. There will not be enough sellers and buyers. Oh, there may be buyers in a real estate sense, but there may not be enough sellers to sell. Okay? So one of the good features of a good market is that low transaction cost, maintaining that internal efficiency. Then the fourth element is that external or information efficiency. Information efficiency is that as and when news comes to the market, it should be analyzed, judged, and it should be impounded into the price immediately. So the immediacy should be there. So that is external efficiency. If prices adjust as and when information arrives to the market, then we know that the market is efficient. If it lags behind and takes a couple of hours or a couple of days to adjust, then we know that we cannot rely on these prices. If this is a bad news, then it is analyzed, digested, and impounded into the price, then we know it is a reliable and efficient setting. Whereas if that doesn't happen with some kind of immediacy, then we know that it is lagging behind. Then we know that the market is not efficient. So internal efficiency is low transaction cost. External efficiency is that maintaining that informational efficiency, right? Okay, organization of the financial market. So that's about a market and characteristics of a good market. It's a good thing that you need to remember even for the exam. As far as financial markets are concerned, we are not going to touch on those microstructure aspects, but we will look at the organization of the financial market. The financial markets are organized as primary market and secondary market. As you know, primary market is the market that deals with new securities. Say, for example, a new company that is going to be listed on the stock exchange will issue stocks to the public. That is a primary market transaction. Whereas those issued stocks are transacted in the market, in the same market, but they are secondary transaction, they are regarded as secondary markets. Let's say, for example, company XYZ or any company issues stocks for the first time. They issue the stocks to the public, receive the money, and then you and I hold on to those stocks. We don't have to hold on to those stocks forever. We go and sell those stocks or buy those stocks if you want to have more stocks in the secondary market. Those are secondary market transactions. That money doesn't go to the issuer, right? So those are secondary transactions. But there are important reasons why we need to have those secondary markets. If there is no proper secondary market, then people will not have any trust in the primary market either. Okay? What's the point of buying something and you won't have any opportunity to sell it? You'll be stuck with it, right? So there should be a secondary market. So we have clear distinction between the primary market and the secondary market in terms of financial market operations. So as I said before, primary capital market is the market where new stocks are issued. It can be bonds, it can be stocks or any financial products. You know, financial engineering has been very active in producing those variety of financial products, right? So in this unit we will look at the broad asset classes, right? The risk management is a critical part of it, or risk management products, but the focus will be mainly on major asset classes, and of course equities and even fixed income. You have some derivative products. We can touch on those things. So instruments issued are in the bond market, it will be new issue of bonds. Say, for example, Argentinian government wanting to raise money, they may go to the US market and issue bonds. The Australian government having a budget deficit may want to raise money. They don't want to issue locally because they will crowd out and push the cost and crowd out the financial private sector. So what they do is they go and issue bonds outside Australia, right, to get money from other markets. So that is how they enter the debt market and issue bonds. It can be the European market, it can be the Japanese market. And the other reason is if you enter the European Monetary Union market, the interest rate is very low. That's what, negative or about under 1%. So to take advantage of it, corporations and corporations and governments can seek those markets and issue those bonds. For example, the Japanese market or the European market or the US market. So effectively what you do is you go and issue those bonds and raise money from those markets at a cheaper rate. New issue of preferred stocks, these are preference shares, and common stocks. These are instruments issued in the primary market. So the issuing entities can be individual companies or corporations, governments, and also municipalities in the US. In Australia, I don't know, these councils we have, they are also very powerful because they raise money in the form of rates and those things. So they can also, I don't see any reasons why they cannot go and issue bonds. They can create a special purpose vehicle and raise money. But there may be restrictions in terms of their ability to go from the government side. But these in the US, these municipalities have the capacity to issue bonds and raise money. We call them as municipal bonds, but the beauty of municipal bonds is that they are tax-free. If you receive coupon, that coupon that you receive by investing in those municipal bonds is not going to be subjected to any taxation. So it is a tax-free income. So that is one of the attractive features of municipal bonds in the US. Again, corporations also can go and raise money by issuing bonds. Say, for example, large corporations with enough financial credibility, they don't need to just go to the bank to borrow money. They can enter the debt market and issue bonds. Issue bond and raise money at a cheaper rate, right? So large corporations, governments often go and issue those things. So what is the role of secondary financial market? It provides liquidity to instruments acquired in the primary market. Say you in the primary market, issuers come and issue these instruments, you buy them, but you don't need to hold on to them. You can go and sell as and when you need to sell them. So the secondary market provides this liquidity aspect. Enough liquidity so that you want to buy, you go and buy, you want to sell, you go and sell. There are enough buyers standby with offer and bid prices to buy and transact those instruments. And also without a proper secondary market, issuers also will have difficulty. Why? Because if I cannot sell those shares that I buy from the primary market, from the firm, let's say Commonwealth Bank issued those shares, if I cannot sell those shares, effectively what I will need is, I will need a higher return. I will demand the Commonwealth Bank to pay me, instead of 5% return, I would demand 20% return. What will happen? This will push up the cost for these issuing entities. So when there is no secondary market, the buyers of these primary market instruments will demand higher return, higher required rate of return. That means the issuing entities will be faced with higher cost of capital. So it may not be attractive enough. So they will have issues with those things. And that's one of the reasons why we need to have a vibrant secondary market to aid the primary market instruments. And also the secondary market aids price discovery. Price discovery in a deeper sense, it is something how information is immediately reflected on a particular instrument. It can be many markets, one product, or one market, many products. That is the essence of price discovery. Say for example, let me take you through this simple example. If you take the stock market in Australia is, let's say, ASX 200. If you take the stock market and also side by side this ASX 200 or the Australian stock market, we have the futures market, SPY 200 index, share price index. What this futures market does is, it provides some indication as to where this spot market or the equity market is going to go. So, looking at these two markets, the share price index 200 or SPY 200 and the equity market, we can learn things about how the equity market is going to move by looking at the performance of this SPY 200 futures index. Forget about it if you don't understand. When you do topic 5, you will understand this. So all you need to understand here is that if you want to predict how the stock market is going to go, just you can look at how the futures market is tracking. What is this SPY 200, SPI 200 index? It is an index that predicts how the stock market is going to go. Okay? So there is a closer relationship between this spot market, we call it as stock market, and the futures market. When you invest in the SPY 200 index, every time the stock market moves by 1 point, you make $25. Okay? Similarly, the S&P 500 US stock market has SPDR 500 futures index. So the futures market and the spot market, they are together, but the futures market makes prediction on how the stock market is going to go, right? So here the price discovery can take place in the futures market, right? Similar example is that we have equity as an asset class, a stock. And side by side we may have credit default swap on those entities. Given that the credit market is influenced by very informed participants, these are very specialists, we may have price discovery taking place in the credit market about the company, about how the company is going to perform. Now, look, this is an introductory lecture, so I don't want you to worry too much about it. The price discovery is about which market is predicting how the other market is going to go. think about that way.
Sorry.
Yes.
And that's on the basis of historical performance.
Historical performance as well as about the new information. So let's say now, economic information, how the world economy is shaping and how the industries are shaping, the interest rate environment is evolving, and all of these factors will be, now we have come to a stage where information is, we have big amount of data coming in. It's judged immediately by the computer, and then judgment is given, good or bad. So this information is again fed into the automatic algorithmic trading maybe, so again that judgments are made. So we live in an information age. So now, if you look at the deeper aspect of this, I'm just digressing on this, the information, the role of information, as an announcement is made, for example, in an exchange traded fund, within a couple of seconds, you will see 60 to 70,000 transactions taking place. So in order to beat everyone, so what I would like, what managers do is, they co-locate their office in the exchange itself so that they can execute the trade immediately. And also information providers like Bloomberg may provide that information couple of milliseconds before all others receive, so that transaction is executed. Yeah? So these things matter. So that is the nature of trading. This can only be done in certain exchange traded instruments. Say you can't do that with things like BHP stocks or Commonwealth Bank stocks. You don't have that much of liquidity flowing. But here in the futures market and exchange traded funds, so this is one of the reasons why I want you to learn more about these exchange traded funds. So I will provide data on these things, and also I want you to go deeper and learn about these things and optimize it and see how the portfolios are evolving. So it will be an interesting one as part of your second assessment. So did I answer those questions or what? Yeah, okay. Any other questions?
Yeah, what's the difference between futures and hedging? So is futures also using the hedging calculation?
Yes, okay. Now let's look at this. So the question is the relationship between hedging and futures market. Okay. Now to answer this, I think it may be premature to answer this, but let's say now we all know that we have portfolios. Now, as a portfolio manager, you have, let's say, $30 million worth of equity portfolio, and you immediately get a feeling that this equity market is going to go down. Equity market is going to decline. What it means is that you have 30 million worth of equity portfolio which is going to suffer. So what you can do is, there are two options. One is you can sell those 30 million stocks, 30 million worth of stocks, and get out of the market and allow the market to decline and go and buy. But the problem is, by doing so, you will wipe out a lot of money from that account through the transaction cost, and it may not be worth. So what you can do is you can hedge your position. When you think the market is going to go down, you can go to the futures market and sell enough of those SPY 200 index to match the 30 million worth of portfolios. It may be just whatever number of futures index that you need to sell to cover that loss. If the market declines, yes, it does decline. See, then you can go and buy those indices and close the transaction, and you make that money in the futures market and compensate that money that you have lost in the spot market, equity market, because you did not want to sell those stocks. You wanted to hedge your position by taking a reverse position in the futures market. You made the money, use that money to compensate the losses here. So that is where I can think of a situation where you have a spot market and the futures market, you hedge your position in the futures market to limit your losses. Okay? Any other questions? Yeah, so you will learn those things over a period. So that the price discovery is that aspect. Price discovery also, in a simple sense, if I'm an issuer, a company issuing stocks for the second time, I want to go back to the equity market and raise money, then what I can do is I can look at the secondary market and see, okay, my stocks are trading at this, so I'm going to price my new issue at this price. So that is also a kind of price discovery. So think about that. Also, the secondary market affects price volatility and market efficiency. The secondary market provides it also captures the price volatility. If, say for example, if you have bonds, if you have long-term government bonds or whatever corporate bonds, and if interest rate is going to be moving in a direction that is adverse to your bond portfolio, then you will see a lot of volatility in those long bond portfolios, right, in the secondary market, given that new interest rate environment. So again, the secondary market provides indication about how volatile the situation is in terms of your securities, and also then it provides market efficiency. As information is impounded into the price, the market moves and efficiency is maintained. Okay, so those are things about secondary and primary markets. So I think let's have a break for 10 minutes, right? And then continue. I just want to make sure that I cover those at least two questions that I have identified. So I will run this through another, I don't know how it's going to, but this is always, the first lecture takes a bit of time. I introduce the subject and you are new, I am new. It just can go out of control. But have a break, please, for 5 or 10 minutes.
Can I quickly flick through that book to see what the difference is?
Yeah, please. So what happens is it's essentially the same.
Okay.
Yeah. And even the questions are the same.
Page 44. Logically, part of the readings.
Yeah.
It didn't seem to stop right in the right place logically.
So if we look at, let's look at the chapters. Let's look at the chapters. So if you go back to, okay, chapter 1 is about investment settings, right? Chapter 2 is about asset allocation and security selection.
Starting with 33.
Yeah. And chapter 3 is about selecting investment in global market.
Starting on page 63.
That is, but they have compromised on, that is chapter 3, right? There is chapter 3. That is organizing and functioning of market. That is,
So they've added 7 pages of something.
yeah, yeah. So, so what they have done is they have combined some of the things. So you're not going to lose much. I would recommend, this is a very detailed textbook and you can
I
hold
took some
on.
comfort in when you read out the front and said, oh, it's a 2012 updated version.
Yeah.
They put it in 2019. This is 2011, only the
Yeah,
year before. So
look, I mean, it's not too far away. And any of the new tables and all I'll have on the lecture notes, so don't worry about it. Okay, cheers.
Just a quick question
Yeah.
about the assignment.
Yeah.
It should be in a report format.
Yep.
So with a cover page, content, summary, abstract, stuff like that.
Yeah.
But we're only allowed to do 1,000 words, right? So the summary will be like 4 sentences or something.
Yeah,
I mean,
yeah,
it will
yeah.
be super short, all
Yes.
the components.
Yes.
And
1,000 words should be
And
fine.
is the summary like introduction, or should the introduction be in the main body?
Yeah, you can have the introduction. It's a report, so you need to have an introduction.
Okay, I can
Is
decide a little on my own what I
yeah.
want.
It'll be flexible. Okay.
There's no
Yeah,
difference.
it happens.
Yeah.
It happens. Yeah. What book are you?
Financial planning.
That's right. Yeah.
Yes.
Yeah. So that's with the Department of Accounting. Yep. Yep.
Yeah, business and law. Yeah. So I had. Yeah. So I'm hoping to do my masters, but I'll see how I go.
Yeah, you
So,
do it.
yeah, I have so many more questions, but I know that the format in lectures are just to sit and listen.
I know.
And I'm like, oh my gosh, it's just created another question in my brain.
Yeah. No, no, job very good.
So,
Yeah.
oh, okay.
Yeah, no.
Okay.
Talk about efficiencies in the market, Cameron, it's only as good as all the participants
Exactly.
follow the rules.
Yeah, exactly.
Retail food group during the week increased
Yeah,
double because they failed to tell the market that they refinanced their debt or whatever.
right, yeah. So you can see, and some people, but in the market also, you will always see that short sellers have a better gauge on the market. They read the same set of information as we read, but they somehow read better than us. So that's why they take that high risk of short selling and sustain that performance. But then again, information is key.
Well, in this case, the company didn't declare it, but obviously they told enough people so shares are being transacted. And when the ASX went to the CFO, they said, well, no, there's nothing to see here, nothing to see here. 2 days later, oh, yeah, well, we've almost refinanced our debt, and their position wasn't, but we hadn't signed anything. It was just a discussion at that point, even though it was the assertion.
Yeah, that's an irregularity, actually.
So, assume the ASX will perhaps analyse it.
Yeah, so that's any new information should be revealed to the ASX first, so that nobody else benefits from that.
We want true efficiency.
Exactly. And there will be, I would think there will be some punitive action on the part of ASX towards that company, because it's you play by the rules, and when you reveal information that are market sensitive to certain section of the people, then you allow you compromise on the market integrity. Yeah. Thank you. Yeah. Any other comments or questions? Okay, let's start. Okay, from now on I'm going to rush a bit, but then it's all known things. You don't need to worry. Okay, let's focus on. So we looked at financial markets. We had a look at markets. Then we looked at the organization of financial markets. Now let's move on to the investment aspect. What is an investment? And we want to see what we mean by investment and what those components that we treat as the return from that investment. We need to identify what those components are, or what those components that build that return we expect from that investment. And there are three aspects. What is an investment? Investment is you can either consume now if you have certain amount of money, or you can defer that consumption by a year or so and put that money towards some investment activities. In order to do that, you should have some attraction to do that. That attraction comes in the form of the time value of money. You could have bought that car that you wanted to buy, but you are deferring that investment, that consumption, by a couple of years or 1 year. To do that, something should be enticing enough to make that decision. So you should be compensated for making that decision of deferring that consumption. You should be compensated for in the form of time value of money. Let's say, for example, your friend comes and says, I need to borrow some money, and you lend $1,000. And if your friend is going to return that $1,000 in 1 year's time as $1,000, you're not going to be happy, right? Because there is a time value of money. Had you invested that $1,000 in the bank account, let's say bank pays 5% or whatever, you would have earned at least $50 for that $1,000 at the end of the day, end of the year. So there is a time value of money. If you are going to defer that consumption today and invest that money, whether it's in the bank or in the equity market or in the fixed income market or whichever market, you expect certain return. So one component is that there is a time value of money. So for the period to which you commit your fund, you expect some kind of return. If you leave that money in the bank account, you will earn that 5% or whatever interest, right? So that is the time value of money. So the duration for sacrificing that consumption. Sacrificing your consumption today and allowing that to take place at a later period. The second aspect is we also live in a world of inflation. That item that you are able to buy for $100 today, you may not be able to buy that item for $100 in 1 year's time. Let's say the overall inflation rate is 3%. Naturally, that item that you are able to buy for $100 today will cost, purely focusing on inflation, it will cost you $103, right? Because prices move up. Inflation eats into your purchasing power. So again, apart from time value of money, inflation is another aspect that you need to account for. because we lose purchasing power as prices move upward, right? Inflation captures them. And also there is a third element, apart from time value of money, time during which you commit your fund, inflation. Inflation is a natural part of life. That item that you can buy today will cost you more in 1 year's time. That is the fact of life. And the third element is that uncertainty. Uncertainty in terms of investment activities, or even if you lend your money to lend your friend some money, and that person may not return that money, right? So that uncertainty is there. So in order to, this investment activity has three components. One is the time value of money. It should account for inflation. The third one is any uncertainty should be accounted for. If you think that the person that you are lending your money is not going to return the money, then instead of demanding 5% return, you would demand 15%. This is one of the reasons why when countries like Argentina go and issue bonds, or any developing countries, when they go and issue bonds with the default history or whatever that financial issues they face, the market demands higher coupon or higher expected return from them. So, for example, Australia with the AAA credit rating may issue a bond with 5% coupon or 5% interest, whereas another country with a bad financial history will only be able to issue that bond at 15% coupon, because otherwise institutions and governments and people are not going to invest in those bonds. It should be enticing enough for the investor to take that risk. So one of the third elements is that uncertainty associated with, or we call it risk associated with that investment. Okay, so investment essentially captures these three elements. One is the time value of money, and the second aspect is that inflation is a reality, so we need to account for inflation. And the third one is uncertainty or risk. Again, that investment needs to account for that risk associated with that investment. Individuals can choose to trade off their current consumption for a larger future consumption, but that in the absence of uncertainty and inflation, at least they should be accounted for that time value factor. Just for foregoing that consumption, the investor should be compensated for that time value of money factor. So that is, we call that as pure interest rate. Pure interest rate is in the absence of inflation, in the absence of any risk associated with that investment, just for deferring your consumption, you should be compensated for. So that is the time value of money, or we call it as pure interest rate. It just arises due to the deferring of your consumption, and so the rate of return in the absence of inflation and uncertainty or risk is just a pure interest rate. Excuse me. Okay, so say for example, if you can exchange $100 today for 104 next year, this rate of 4% is just the time value of money. Just for deferring your consumption by 1 year, you need some compensation, you need some return. That 4% is the time value of money factor or pure interest rate. Let's say there is an inflation of 2%. Now we live in a real world, and apart from that pure interest rate, we also face an inflation of 2% in the economy. So in that case, what you would demand is, you would not only demand this additional $4, in addition to that $4, you will also demand $2, accounting for that 2% inflation. So you will demand, okay, I'm going to defer my consumption. For the sake of pure interest rate, I need $4 or 4%. For the sake of inflation, I need another 2% or $2. So I need $106 at the end of the year to make this investment decision. So that means you are lending that $100 today or investing that $100, but you expect this 6% return. Okay. But then the third element is that if the future repayment is in doubt, if the risk is going to be present, then you also will demand for compensating for that the risk component. So instead of requesting $4 or 4% for the pure interest rate and 2% for the inflation, you may demand, give me another 4% because I'm bearing this risk of losing my entire $100. So unless you give me another 4%, I'm not going to lend this money, or I'm not going to invest in this venture. Okay, so that means $110, you require $110, $106 for bearing the investment risk, and $4 is for bearing that risk premium, because the risk premium is that component of the total return that you need to bear that additional risk. It may be a business that may go bankrupt. There is a certain percentage of chance, so you require that additional return to compensate for that. The same goes with any company that you invest in. If the business risk associated with that company is high, then you will require more return from that company. So the required rate of return will be higher, right? So that's the natural response from anyone. If we think this investment is going to be problematic and we may lose money, then we are not going to just put the money just for the sake of investing. We will require higher return from that. Unless we get higher return, we are not going to commit our fund. That's the real world situation, right? Okay, so the textbook definition is that investment is the current commitment of money for a period of time in order to derive future payment that will compensate for three elements. That will compensate for, one is the time the funds are committed, that is the pure interest rate, and the second one is that okay, so this doesn't work. Okay, the second one is that expected rate of inflation, and the third one is the uncertainty associated with that. For all of these things, so the interest rate premium, the inflation premium, and the risk premium. Those are the three elements that you need to, that you will demand in order to invest in that asset. So an investor can be individual, government, or a managed fund, or superannuation fund, or a corporation, right? Right, having looked at financial markets, investments, and the need for accounting, the need to account for those three elements in terms of investment: inflation premium, interest premium, and the pure interest rate, and then the risk premium. Now we move on to measuring performance. Now the third aspect of today's lecture is about performance measurement. How do we measure performance of individual assets? Simply, there are two measures. One is the historical rate of return, and the other one is the expected rate of return. Historical rate of return is by looking at the starting point of the investment and the ending point of the investment, and we just want to work out what the return that we generated during that holding period. During that holding period, it can be 3 years or 5 years or 1 year or 6 months. How much return have we earned? That is the question that we tend to answer in terms of the historical rate of return. The expected rate of return is somewhat different, in the sense we bring in some expectations as part of the process. Okay? Expectations as part of the process. We will look at that. So in order to measure historical return, we rely on the holding period return. Holding period return is what? There is a starting period for an investment. There's an ending period for that investment. We just look at the ending value of that investment and then compare it with the starting value of that investment. That gives you the holding period return. So holding period return is simply the ending value of the investment. That is, say you would have invested 1 year ago, and after 1 year you invested $1,000 on let's say the stock market, and after 1 year you have generated 1,200. So the ending value of that investment is 1,200. The beginning value of that investment is 1,000. So 1,200 divided by 1,000 gives you that holding period return. Now, holding period return is a unitized figure. It carries that investment component as well, right? When you take that holding period return and take -1, you get that yield. You remove that investment part, and now you are talking about how much that particular investment has yielded. So you take the holding period return, which is ending value divided by the beginning value, which is a unitized figure. It carries that investment component as well. Then -1 provides you how much it has yielded. In terms of, we call it as holding period yield. Then we can annualize this holding period yield by taking the nth root of the holding period return. So that is, when we do that question, we will understand. So you can take the holding period return, but you annualize it. Say the holding period can be more than 1 year or less than 1 year. But what is the benchmark? Benchmarks, you might have earned some money over 6 months or 3 months or 5 years, but it doesn't give you a mental picture as to give you it doesn't give you a benchmark. It's always the annual figure, annualized value gives you a benchmark, because everything is expressed in annual form, right? So when you have historical return expressed in as holding period return, you need to somehow make sure that you annualize it. How do you annualize it? You bring that to the annual form by taking the nth root. We will do that later. So holding period return to the nth root gives you the annualized figure. Say if this is if this is the return over 3 years, 1 over 3 will extract that period of performance for a year. If this holding period was for 6 months, so 1 over 0.5 will boost that performance to give you that 1 year performance. We'll come back to this. Okay, let's look at this example. Your investment of 250 in a stock A is worth 350 in 2 years' time. 350 in 2 years' time, while in $100 investment in stock B is worth 120 in 6 months. Here we have 2 years and 6 months. These are not comparable. So we need to bring them to a common ground, which is in the annual form. That will give us the ability to compare apple with apple. Okay, you invested 250 and after 2 years it has turned out to be 350, but that doesn't tell us much. You also invested 100 at the beginning. After 6 months it has turned out to be 120. Again, it doesn't tell us. We can't compare these two, but unless we bring them to a common ground where these are annual performance, we will not be able to compare them. So let's bring them to an annual form. So the annual holding period return for the first investment is, because it took 2 years to turn this 250 into 350, right? So the holding period return, HPR, is simply ending value, that is 350, divided by the beginning value 250. But then this happened over 2 years. So we need to make sure that we take the nth root, that is 1 over 2, because it took 2 years, right? So that gives us the return of 1.182 minus 1, it is 18.32%. Now if I show you the calculator, I know you can do this with your calculator, but let me just show you this. Okay. I have my off-campus students as well, so I need to be all right, so that is of course 350, ending value 250, that is fine. Hang on a minute. 350 divided by 250 to the power of what is that? 1 over 2, 1 nth root, right? Over 2 years. 1 over 2, that produces 1.1832 minus 1 is 18.32%. The same situation with respect to investment B, you invest $100 at the beginning and you end up with 120. Is that 120? 120 after 6 months. Here we are talking about not 2 years but 6 months. Within 6 months you have turned 100 into 120. So how does it compare with the annual form? Let's take again go through these steps. Let me just use the bracket. So that is, what is the ending value? It is 120. divided by 100, right? Yeah. So 100, bracket close, and then we need to make sure that we take the nth root, right? But over what period did this happen? 6 months, right? 6 months means 0.5 year, right? So 1 over 0.5 enter 1.44 minus 1, that gives you 44%. That gives you 44%, right? So you turn 100 into 120 in 6 months' time, whereas you also turn 250 into 350 over 2 years. Now, having converted them into the annual form of 18.32% and 44%, we know that we have done well with investment B, right? Until this point, we were not sure that 250 turned out to be 300 was a big number. But then in reality, we turned 100 into 120 in 6 months, and when we bring them to the common ground of annual form, we know that the performance is better in terms of the second asset, that is asset B, right? So make sure that you use your calculator to practice this, please. Right. Computing historical rate of return. It's basically the arithmetic return. You sum up all the holding period yield and divide it by n. This sigma is nothing more than just adding certain values. Let me just tell you. Okay, so if you want to add, okay, now you have let's say 2 plus 3 plus 4 plus 5 plus 6. Now we want to add them. We want to add these numbers. In mathematical form, we can express this as sigma. I is equal to 1 to n is equal to 5. So that value is 2 plus 3 is 5, 5 plus 4 is 9, plus 5 is 14, plus 6 is 20. Yeah. Sorry? Oh, right, okay, sorry. I always make this mistake. Right. Can you see that? Okay, so these are individual numbers, 2, 3, 4, 5, and 6. Now when we want to add them up, we just put this through the loop. I is equal to, when I talk about I is equal to 1, I'm talking about the first number. Take that number, and when I talk about I is equal to 2, I'm talking about the second number. Take the first number and add the second number with that. And when I talk about I is equal to 3, I'm talking about this number. I is equal to 4, I'm talking about this number. I is equal to 5, I'm talking about this number. All of these things are added. So this sigma is nothing more than just summing up. Okay? So that's what we have. That's what we have. This arithmetic mean is just simply we take the holding period yields and sum them up. Individual holding period yields, take them and sum it up. That's sigma HPY is that, and then divided by the number of years. If there are 3 years of holding period returns, you take them individually and add them up and divide it by n. So sigma indicates the action of summing up a series of values. We will be using these sigmas quite often, so I just thought I should cover that. Okay? Right. Now the holding period yield. Now let's look at a portfolio situation. What is a portfolio? Portfolio is a basket of investment that has different assets. Now if you look at this example, it is from Exhibit 1.1, and you will have from other versions of the textbook as well. There are three investments, A, B, and C. A, B, and C are the three investments. And the number of shares that altogether we had $20 million, and we bought 100,000 shares in A, 200,000 shares in company B, and 500,000 shares in company C. Now we spent that 20 million on these three stocks. Their prices were at the beginning were 10, 20 and 30 respectively. Right? So you had 20 million, you spent, you bought 100,000 shares in A, 200,000 shares in B and 500,000 shares in C. And the share prices were that, such and such. So initial investment at the beginning, 10 times 100,000 shares accounted for 1 million, $20 times 200,000, 4 million, and then you bought 500,000 shares for $30, 15 million. So that accounted for all your money of 20 million. That is the beginning investment. So you invested this 20 million into these three assets, A, B, and C, in different percentages. If you look at the percentage you invested, actually you invested only 5% of your total money. 1 million over 20 million is what? 5%, right? 1 over 20 is 5%. And 4 million over 20 million out of 20 million is 20%. And 15 million out of 20 million is 75%. So you allocated 5% towards asset A, 20% towards asset B, and 75% towards asset C. And you ended up with investing the whole amount of your 20 million across these three assets. And at the end of the holding period, that asset A turned out to be $12, asset B turned out to be $21, asset C turned out to be $33. Now at the end of the investment period, now you have a portfolio value of 12 times 100,000 shares, 1,200,000. 21 times 200,000 shares, 4,200,000. And $33 times 500,000 shares, 16,500,000. Here we initially had a portfolio of 20 million invested across these three assets, and at the end of the holding period we ended up with 21.9 million. What we are going to do is we are going to evaluate what our performance was. Now it's not a single asset, it is a portfolio of assets. So there are three assets. So the holding period return for the first asset is 1.2. Why? The ending value is $12 divided by the initial value of $10 is 1.2. You can also do this with the same thing. 1,200,000 divided by 1 million is 1.2. Similarly, for the second one is 1.05. Third one is 1.1. In terms of yield, 1 minus that holding period return gives you 20%, 5% and 10%. But then you invested in a discriminatory way by investing 5% on asset A, 20% on asset B, and 75% on asset C. So those returns should be weighted as well. So when you weight those returns, 20% times 0.05 gives you the weighted holding period yield of 0.01, and 5% times that 20% is 0.01, 20% times 5% is 0.01 again, because you invested 20% in asset B. 75% or 0.75 in asset C times 10% return is giving you 0.075. Totaling that up gives you 0.095 or 9.5% as the portfolio return. So that gives you a holding period return, a holding period yield of, if you compare this 21,900 divided by 20 million, it gives you 1.095 as the holding period return, minus 1 gives you the holding period yield of 9.5%. Here in this example, you see how a total amount can be distributed into 3 different assets, and at different percentage you are investing, and at the end of the investment period you ended up with certain amount that produced that holding period return of 1.095 and eventually that holding period yield of 9.5%. Yes?
What if each of the investments were held for a different period of time? For example, if A was held for 6 months and B 1 year and C 2 years.
Yes.
Can we still calculate the combined holding period return and yield?
Okay, so you are talking about a portfolio where you hold that asset 1 for 6 months, then asset 2 as part of the portfolio, you hold it for 1.5 years, and so on. That's a good question. So how do you bring that comparable form of annual return? Is that the question? Yeah. So what you need to do is you need to individually annualize it and sum it up. Individually annualize it and sum it up.
Previous slide 1 divided by 0.5, 1 divided by 2, and then sum all of them divided by the number.
Which one? Yes, in the previous slide, say HVY, yes. Yeah. So you have to individually do it, because the question is this. If you have a portfolio where here the investment takes place right at the beginning and we hold it for a while, and at the end of the investment period we ended up with this amount. But the question we have today is that what if we have a portfolio where this holding period is not uniform, holding period differs. That's the natural part of investment activities. You buy some stocks and then you sell it, you rebalance your portfolio, and it's very dynamic, right? So in that case, to bring that to a benchmark performance, you may hold on to a stock for 2 days only. But over that 2 days, you may have earned $2, which will be, in annual form, it can be 200%. So individually you need to account for that and generate the holding period return and see the performance of individual assets. Good question, yeah. Thank you. And I hope that makes sense. Okay, so we will do that more and more. Okay, all right. So now, so far our focus was on arithmetic return, just the average. But then there is another return form called geometric return. Geometric return is simply the holding period returns are, we take the product of all the holding period returns and then take the nth root of it, minus 1. It produces a more efficient return, because sometimes this arithmetic return that we use commonly can be misleading when there is volatility in asset performance. So that geometric return eliminates that inefficiency and accounts for those the volatile performances. Okay, so we'll look at that. So it's geometric return is simply what you need to do is you need to take the holding period return for each year and multiply that and take the nth root of it. If it's for 3 years, holding period return for year 1, holding period return for year 2 and year 3, and 1 over 3 minus 1 gives you that holding period return. Let's look at this example, geometric return and arithmetic return. Suppose you invested $100 3 years ago and it is worth $110.40 today. So you invested $100 3 years ago. It has turned out to be $110.40 today. Over that 3 years, every year you measure the performance. At the beginning of year 1, year 0, you would have invested 100. At the end of the year, it turned out to be 115. That 115 was the value at the beginning of year 2, and that turned out to be $138. But that $138 at the beginning of year 3 turned out to be $110.40. So although you invested $100 at the beginning, it went through a volatile performance. It went from 110 to 115, then it went to 138, declined to 110.4. Arithmetic, let's see which return gives you a better picture about this performance. So it's a volatile performance, right? It went up, and then declined. Arithmetic return may give you a particular return, but that may not be the entire picture. So geometric return, let's see how comparable they are. Using the table above, this is from your textbook, okay? I'm using the textbook example and I'm closely following your textbook, okay? So as you know, the arithmetic return is simply the holding period yield, sum of all the holding period yields divided by n gives you the arithmetic return. Whereas the geometric return is the product of the holding period return for each year, the product of that holding period return, nth root of it minus 1 gives you that. Let's look at the example. So in the first year we had 15% return, right? $100 turned out to be 115. So 1.15 in terms of yield, 1.15. So 115 divided by 100 gave us 1.15. Minus 1 gives you 15% yield. And in the second year, it turned out to be 138. 138 divided by 115 gives you 1.2. Minus 1 gives you 20% return. Then in year 3, it turned out to be, you ended up with 110.4, but you had initial value of 138. So 110.4 divided by 138 gave you only 0.8. In yield form, it is 0.8 minus 1 gives you negative 20%. Now let's see how this arithmetic return works. 15% plus 20% plus minus 20 divided by 3 gives you earn 5% return, because you had $110 at the beginning. At the end of the third year, you ended up with $110.40. That gave you 5% return. So 15% in year 1. Year 2 you earned 20%. Year 3 you ended up losing 20%. So that these two cancel out, and then 0.15 divided by 3 gives you 5%. So over that 3-year period, every year you earn some return. The average figure is 5%. Let's see what the geometric return does. So the first year return is 1.15. Holding period return is 1.15, right? So 1.15 times the second year return is, holding period return is 1.2. 1.2. And the third year holding period return is 0.8. So multiply 1.15 times 1.2 times 0.8 and take 1/3 of the third root of that. So that is so what is that? 1.15 times 1.2 times 0.8 gives you 1.104 to the power of 1 over 3. So this is a very user-friendly calculator, so it may be 1.03353, yeah, minus 1 gives you 0.033. Okay, so you can see the difference between the arithmetic return and the geometric return. Arithmetic return just gave you 5%, but whereas the geometric return has recognized the volatility in the performance and just subdued that return and gave you only 3.5353. So when returns are uniform each year, arithmetic return and geometric return will give you the same value. But when returns are variable, say for example, if you receive 20% year 1, 20% year 2, 20% year 3, it will give you 20% for geometric return and 20% for arithmetic return. But if you have varying performance, like in this case, 115, 1.15, 1.2 and 0.8, then always the geometric return will give you a lesser return given the volatility. Okay? So that is evident here. Arithmetic return gives you 5%, whereas the geometric return says, no, it's not 5%, it's 3.353. It just accounts for that volatility issue. So the performance in terms of, sorry, I'll just see. In terms of these two measures as performance measures, when rates of returns are the same for all years, both of them will return the same. When rates of returns are not the same for all years, AM will always be higher than the geometric return. But understand the efficiency of these two returns. When volatile series are presented, GM will capture the volatility aspect better than the arithmetic mean performance. Okay. Okay. So again, another example of AM and arithmetic return and geometric return. You have again from the textbook. consider for example, a security that increases in price from 50 to 100 during year 1 and drops back to 50 in year 2. So you invest $50 at the beginning of year 1 and it turned out to be 100, and then again in year 2 it drops to 50. Let's look at, so you started with 50, you ended up with 50. But let's see the discriminatory ability of GM against AM. Okay, if you look at that, the arithmetic performance is just in year 1 you made 50 turned out to be 100, so it is 1 plus that 100 turned out to be 50 again, so it is minus 50, right? So that gives you a figure of 0.25 or 25% return. You had $50, you earned, it turned out to be 100 and then again back to 50. So that gives you a 25% return arithmetic mean. But so look at that geometric mean. It's the holding period return is 2 because 50 turned out to be 100 times, then the second year return is 0.5 and the root of 2 gives you 0% return, 0% return. Because you started with 50, ended up with 50, so there's no performance. So we can see GM is performing better here. Okay, having said that, let's move on to expected return. So the expected return, I think I'll have to do the tutorial question first thing in the next class, and because it's just the timing is not enough. But let me just go through this. At least I need to wrap up this lecture. So expected return. What is an expected return? When you form expectations about how an asset is going to perform by implying a probability value on a particular performance outcome, you form expectations, expected performance. So it is the probability of return times the possible return gives you the expected return. So expected return is simply, so you can see sigma I is equal to 1 to n pi times Ri. Let's look at an example. This is the typical example. Here what we have is the rate of return of an asset. Let's say it's a stock, BHP or something. Now there are three economic conditions. One is that the economy is going to be very strong. Economy is going to be strong with no inflation. Under such condition, your stock will earn a return of 20%. But the probability of having that state of the economy is only 15%. The second scenario is that we have a weak economy with above average inflation, and the probability of having that is again 15%. But under such condition, your stock will earn a negative return of, generate a negative return of 20%. But the third scenario is that your economy will perform as it performs now. There will be no major changes, but the likelihood of that is 75%. Under such condition, your stock will earn 10% return. Now, so they have given you three economic scenarios and the underlying probability associated with those three scenarios and the respective performance. 20%, negative 20% in a bad economic condition, and 10% under normal economic performance. Now, how do you generate the expected return? You take that probability value of 15%. There's a 15% chance that the economy will be stronger with no inflation, under which the company will earn 20% return. So 0.15, 15% times 20% return, plus the next scenario is that the economy will go through issues and above average inflation. Under such condition, your company will generate a return of negative 20%, the chances of which are 15% again. So 0.15 times negative 20, negative 0.2, 20%. And the next situation is that the economy will perform as normal, and the chances of having a normality is 70%. Under such condition, your company will only earn 10%. So 0.7 times 10% gives you, summing up, gives you 7%. This is the expected return. So you identify the underlying probability associated with a given scenario and attach that probability outcome to a given performance outcome. So that gives you 7%. That's how you form expected return. You are forming expectations about how the future is going to evolve, right? So that's that. And the measure of uncertainty for that is just the standard deviation. Standard deviation is simply you take the return and see how it deviates from the average return and squared value of that, and that is the variance of that return. That measures the risk associated with that. And when I do a question, you will understand, and the square root of that variance is the standard deviation. It's like this. On average, you earn 10%. On average, you deviate by 15%. So effectively, in the worst case scenario, given one standard deviation, you may end up with negative 5%, because 10% minus 15%. Or in the best case scenario, 10% average return, plus everything is going to be well. So then you may end up with 25% returns. I will go back to it again and explain that clearly when I cover that example. Okay, let's look at this expected return scenario. Now we worked out the expected return as 7%, right, in the previous example. Now let's look at how the risk is evolving. One side of the story is return and the other side of the story is risk. We need to capture both of them. So in this case, what we are interested in is how individual returns, these individual returns, 20%, negative 20% and 10% under each scenario deviates from the average return. In this example, 7%, right? So individually here the first return is 20%, the average return is 7%. So 20 minus 7, squared value of that. The chances of having that is 15%. And the same goes with negative 20% minus 0.07, squared value of that times 15%, and 10% minus 7%. The 7% comes from the average return, right? The expected return. That gives you a weighted value of 0.0141. It doesn't mean anything because it is a squared value. We need to normalize it by taking the square root of it. So now we are able to express that in percentage form. On average, under these three scenarios, the stock was able to generate an expected return of 7%, and the risk associated with that return, that asset performance is 11.874%. Now we are talking about the same values, apple with apple. 7% return with a risk of 11.84%. So we need to compare that. On average, you can earn 7%. In the best case scenario, it can be 7% plus 11.874. Why? Because it captures volatility, right? If the stock goes up, you perform well, right? But if the stock goes down, we look at the negative side. So these are the two measures: expected return and risk. We will go through this again and again during the whole trimester, but understand, making sense of it, you will make sense of it. Even if you don't make sense of it now, don't worry. You will make sense of it, okay? Okay. But then these individual measures, return and risk, they are fine for a standalone asset. But when we compare them, they may give you misleading outcome. Not all returns with different standard deviation can be comparable. So you need to again bring them to a common ground. Common ground, we call it coefficient of variation, because different expected return with different risk level cannot be compared. So if two assets have different expected return and different risk level, we cannot evaluate and say, yeah, asset A is better than asset B, asset B is better than asset A. In order to make a judgment on that, we need to resort to a relative performance measure like the coefficient of variation, where we take the standard deviation of individual asset and divide it by the expected return from that asset. By doing that, what you are doing is you are measuring per unit of return how much risk are we bearing. Because we are talking about standard deviation, the numerator, it's all about risk, right? The denominator is return. So per unit of return, how much risk are we going to bear is what is produced by this coefficient of variation. Let's look at this example. Now, the expected return for investment A and investment B is 7% and 12%. Whereas the standard deviation for investment A is 5%, investment B is 7%. Which one would you prefer? Investment A or B? We don't know, right? We can't say about that because these are different mean returns and different standard deviations. What we need to do is we need to bring them to a common ground where the relative measure can dictate us, okay, this is the way to go. So we need to work out the coefficient of variation. So 5% is the standard deviation. Where is that? The standard deviation of asset A is 5% divided by the return of the return on asset A is 7%, right? That gives you 0.714. Whereas for investment B, the standard deviation is 0.07. The return is 0.12, that gives you 0.583. Let's understand what these figures mean. What does it mean 0.714? So per unit of return, we bear 0.714 risk with respect to asset A. Whereas with respect to asset B, per unit of return, we bear 0.583 of risk. So always we hate risk. The lesser, the better in terms of risk. The more return is preferred to less return, right? We want more return in terms of return, but we want less risk. So in this case, in order to earn 1 unit of return, investment A is bearing a high level of risk, whereas investment B is bearing lesser amount of risk per unit of return. So here we can say investment B is preferable, right? Is that the answer? Yeah, that is the answer. So B has less relative variability or low risk per unit of expected return. So B is preferable. So understand that when you have different expected return and different variability, we need to bring them to a common ground called coefficient of variation, and there we are able to evaluate per unit of return how much risk are we bearing. That's simple as that, okay? So how do we choose investment? So it's a process of choosing a particular asset class and then allocating a particular percentage of weight. Okay, so, there are in the case of asset allocation, the two key decisions are which assets are we investing in and what percentage do we put towards that particular investment, right? Empirically, 90% of the fund performance, 90% of the performance is dominated by the type of asset class that you choose and the policy decision or policy weights, in the sense that percentage of investment that you allocate towards a particular asset class. So you may allocate 75% towards equity and 25% towards fixed income. That is your policy weight. And the type of asset class that you choose, equity and fixed income, these two will determine what your performance is going to be. Empirically, it has shown that the performance, 90% of the performance variation can be explained by these two decisions. What type of asset class you choose and what percentage you invest in individual asset classes. So these are the two variables that determine the performance. Okay. Okay. Historically, if you look at the performance of individual assets, I'll just finish in 5 minutes. So next week, I'll start with these tutorial question and then I'll get on with the lectures, okay? Historically, small stocks have performed well. Inflation and tax have a major impact on return. For example, municipal bonds don't have tax, so they perform better compared to other asset classes. Similarly, inflation again eats into your return as well. So treasury bonds lose performance because they perform in line with inflation. So again, this is the historical story of performance, asset performance, and then again, when it comes to individual investing, as financial planners, you know, people go through different phases of life. Early in the accumulation phase, then the consolidation phase, and then the final phase of spending and gifting. As we age, move into twilight years, we tend to give whatever we have and just go. So in these different periods of life, we have different patterns and different attitudes towards risk and return. At the early stages, we are willing to take more risk, and at the later stages, almost indifferent and giving away, and we just want to hold on to some kind of income generating form of life. So that is, so have a look at that life cycle side of that reading and chapter 3, I think. Then finally, we touch on these types of orders. We can place market orders if you are engaged, if you invest in the stock market, you can place market orders or limit orders or special orders. Market orders means you just to place an order, just tell the broker, go and buy this stock. Doesn't matter what the price is, prevailing market price will be the execution price. Whereas limit orders, you place an order and say buy if the stock comes to $40 or $45. There you are instructing the stockbroker, okay, this is the price at which you should buy. And there are also stop loss orders where if you are engaged in short selling, you don't want this asset to go up above certain values. So at that point you hit the reverse button, and at the same time stop loss orders are if you have already bought an asset, and if the asset is declining in value, then you want to cut your losses. So it becomes a sell order at that point. Margin transactions, again, you have your pot of money and you borrow and further enhance your performance by investing in these risky assets. Again, that can be a risky affair as well, and there can be margin call. When the margin call comes, you have to somehow get rid of your assets and sell and settle that money. Okay, so that's have a look at that. Short sale is an activity where you don't have ownership for assets, but you borrow those stocks and sell it in the market because you think that the market is going to decline, so you can sell it now, and as it declines, then you can go and buy and return that stocks. It's a short selling activity. Short sellers are engaged in these activities thinking that the stock is going to decline, and you predict that, and as it declines, you go and buy back and return the stocks. And during that period, you also need to compensate for any dividends or any other issues associated with that stock. So far we looked at the characteristics of markets, and we looked at investments and the type of elements that we need, that we cover as part of investment, measures of historical returns, measures of risk, and also types of bio